Welcome to our webinar this morning. We're just going to wait a minute for participants to join with us. So if everybody would wait another moment, we'll get started in just another minute. Again, good morning. We're waiting a moment for everybody to join in from the waiting room. We're just going to give this another minute for attendees to arrive, and then we'll get started with our webinar. Okay, it looks like we've got a good group that's joined now today, so we'll go ahead and get started. Good morning and good afternoon. Welcome to the National Aircraft Finance Association's webinar, Managing an Aircraft Loan Portfolio in a Pandemic. NAFA, by background, represents a very diverse group of approximately 200 member companies that all support pretty much every aspect of the purchase and sale of an aircraft. Our goal with our webinar series is to connect NAFA members with experts on issues topical right now to our industry, and there's a lot going on. You'll see a variety of practices employed by a broad cross-section of our membership, and you'll see how they're managing their businesses today. Our format today, it starts with a keynote economic overview, followed by a panel of experts who will discuss how they're managing and supporting aircraft loan portfolios. We'll also have a Q&A session at the conclusion, so please take your time and feel free to enter a question in the Q&A section on the Zoom tab at the bottom of your screen. You'll see a couple polls pop up during the meeting, and at the very end of the meeting, we'll have an opportunity for you to provide feedback via questionnaire as you exit the Zoom call. So to start with today, we're very pleased to have Gus Faucher join us. He's the Chief Economist with PNC Financial Services Group. Prior to PNC, Gus was a Senior Economist with the U.S. Treasury Department and a Director and Senior Economist at Moody Analytics. He's often seen or heard participating on CBS Radio, NPR, Marketplace, cited in the Wall Street Journal and the New York Times, among other places. In addition, we appreciate his participation in the aviation finance community, and we're very happy to have Gus join us today. Gus, thank you, welcome, and appreciate your comments today.
Thank you very much, Jim. It's a pleasure to be here this morning, and I'm glad we could all gather together virtually. And so I will be speaking for the first part of the program, and if you have any questions during my part of the presentation, just go ahead and type those in, and I'll try to answer as many as I can once I wrap up before the panel discussion. Obviously, we're in a period of very extreme economic dislocation. So there's a group called the National Bureau of Economic Research. They date expansions and recessions in the United States. And they announced in June that the United States economy had entered into recession in February of this year. That marked an end to the longest economic expansion in U.S. history. It lasted 128 months from the middle of 2009 to early 2020. And this is a very different recession than what we've seen previously. Previous recessions, if we think about the financial crisis and the Great Recession in the a decade or so ago, that was caused by problems in the housing market that spread to the financial system. If we think about the recession in the early 2000s, that was caused by the bursting of the tech bubble. The recessions that we had in the early 1990s caused by problems in the savings and loan industry and commercial real estate markets. This recession was caused by something external to the economy, the coronavirus pandemic. And so it's a very different recession from what we've seen previously. And in fact, it looks like that the recession likely ended in April or May of this year. So it will be a very short-lived recession, but it is also going to be a very severe recession in terms of lost economic output. We saw a lot of economic activity in the United States come to a halt. We've also seen an extraordinary policy response from the Federal Reserve and the federal government, and that is supporting a recovery that we're in right now. But there's still a lot of questions about the path of the pandemic and so forth, about the shape of the economic recovery, and we're just in a very, very difficult environment right now. So with the coronavirus pandemic, about one half of the US economy is at risk. If we think about, if you go back to your college macroeconomics class, GDP, output of goods and services in the United States, that's composed of consumer spending, which is about 2/3 of the US economy, in business investment and investment in housing, government consumption, government spending, and then also exports minus imports. And so a lot of the economy is at risk. Many aspects of consumer spending are at risk. So obviously consumers are still spending on healthcare, they're still spending on utilities, but we saw big declines in spending on many types of durable goods, things like cars and appliances. Non-durable goods, clothing sales dropped very sharply in the wake of the pandemic as people stopped going out. A lot of consumer services, people aren't going out to restaurants, they aren't going on trips. And then business investment was very weak. Businesses have pulled back on their investment. And then we also saw a contraction in home building. So you put it all, and then exports were weak because of the global economy and disrupted supply chains. So you put it all together, about one half of the US economy was at risk, remains at risk from the continued spread of the coronavirus pandemic. And obviously that's caused enormous dislocation in the United States economy. And we saw that in the data that we received. If we look at the data from February to April, so before the pandemic started to when the contraction in economic activity was its greatest. So for example, we saw restaurant sales in the United States fall by about 55%. We saw auto sales fall by 50% over that period of 2 months. We saw housing starts fall by about 40%. We saw industrial production, output from manufacturers, mines, utilities, that fell by about 18% from February to April. Excuse me. And then we saw about a 5% contraction in real GDP in the first quarter of 2020. And that was with the pandemic really only taking effect in the last 2 weeks of the quarter. And so we saw an enormous contraction in economic activity. That being said, we also saw a huge increase in, first of all, in some areas of spending. So spending on food and beverages, basically grocery store sales, that rose by about 10% between February and April as more people stayed home. But we also saw a big increase in household income. The stimulus package the first part of the stimulus package was passed in March, and then we saw additional stimulus spending in March and April. We had huge transfers to households in the form of the one-time stimulus payments. We also had expanded and extended unemployment insurance benefits, providing many more people were made eligible for unemployment insurance, and they also received an extra $600 a week benefit. And so because of that, we actually saw what we call after-tax household income increased 10% between February and April, even as the economy lost more than 22 million jobs over that period. So we received enormous stimulus from the federal government. And so once households were able to go out and spend again, they actually have the cash to do so, even with the enormous loss of jobs and labor market income that we saw in the economy in between February and April. As I mentioned, we saw the economy lose about 22.5 million jobs between February and April. It basically wiped out about 9 years worth of job gains. We saw the unemployment rate go from 3.5% in February to almost 15% in April. That's the highest unemployment rate we've seen since the Great Depression in the 1930s. The pace of job losses is simply unprecedented in the US economy, but we have started to see the beginnings of a labor market recovery. So we've added about 7.5 million jobs in the US economy in between April and in June. We saw the unemployment rate decline from a peak of 14.7% down to about 11.1% in June. That's a little understated. There's some methodological issues, but we have definitely seen an improvement in the labor market as businesses that were closed temporarily during the pandemic have started to reopen. But still, even though we've seen huge job gains, we're still down by about 15 million jobs from where we were in February. The unemployment rate still remains very, very high. And we're starting to see some of that stimulus impact fade. So I think that's going to be very important for the economic recovery. A couple reasons why I'm encouraged by the potential for an economic recovery. First of all, as I mentioned, we had that big increase in federal stimulus spending that is supporting economic growth at a time when the private sector is very, very weak. Second reason is the consumers were generally in pretty good shape heading into this recession. Compared to what we experienced during the Great Recession, when consumers had very heavy debt burdens, were borrowing a lot, had high interest payments around going into that recession. This time, the household savings rate was much higher. Consumers have been very appropriate with their debt. They don't have nearly as much debt as they did last time. They had much higher wealth heading into this. And so that is certainly a positive. And I'm hopeful that as the labor market continues to improve, hopefully as we get more economic stimulus from the federal government, the consumers will be able to maintain their spending in the second half of 2020 and into 2021. Consumer spending accounts for about 2/3 of the US economy, and so that is going to be vital to the economic recovery. That being said, business debt burdens were higher heading into this recession than they were heading into the Great Recession. Now, low interest costs have offset that somewhat, but certainly I am concerned watching corporate debt burdens. One important factor for the recovery is going to be how quickly do businesses reopen. Obviously, there has been a lot of aid to small and medium-sized businesses. In particular, we had the Paycheck Protection Program. That was about $750 billion in low-interest loans to small and medium-sized businesses. Those loans will turn into grants if those businesses reopen and rehire most of their workers. So the program was specifically designed to have small and medium-sized businesses hold on to their workers through the worst of the downturn and then hopefully re-employ them. And if that's the case, those loans will turn into grants, which provides a strong incentive. The expectation is, the hope is that small and medium-sized businesses will be able to get through the worst of this, reopen on the other side, and that will limit the permanent job losses. We may have a lot of temporary employment losses, but the permanent job losses will be much smaller, and that businesses will be able to reopen and rehire. Now, obviously, that is a concern as we have seen the renewed spread of the virus over the past couple of months or so in many parts of the country. We see skyrocketing caseloads in many states. And that, of course, does raise concerns about the strength of the economic recovery. We had the initial hit to consumer spending, to the ability of people to get to work, to downturns in travel and tourism and so forth in March, and then especially in April as we saw state mandated restrictions on economic activity. We've seen some states gradually loosen those restrictions, but I think it's more important at this point, rather than what governments are doing, it's more important how consumers feel. Do they feel comfortable going out and spending? And if consumers don't feel comfortable because we see the continued spread of the virus, then that is going to make for a much more difficult economic recovery. It's going to mean more business closures turn from temporary to permanent. That means that people will see permanent job losses. It's going to take time for new businesses to reopen, to take those place of the old businesses. We're going to see shifts away from, for example, traditional retailing towards more online services. We may see shifts in travel and tourism from air travel to more at-home travel, those types of things. And so it takes time for the economy to work through those shifts. So the longer the pandemic itself lasts, the slower the economic recovery will be and the greater the permanent damage to the US economy. So in that respect, I'm discouraged by what we've seen with the renewed spread of the virus over the past month or so. I think we will need additional federal stimulus. Congress is working on a package. In particular, I think that there are three areas where it's very important that we get additional assistance from the federal government. The first is in combating the pandemic itself. As I mentioned, consumers aren't going to feel comfortable until we see the pandemic start to slow. And so therefore, I think any investments that we make in public health in terms of testing, in terms of containment, I think that's going to be vitally important to ensuring a recovery from the pandemic, ensuring consumer confidence and the ability of consumers to go out and spend. Second area that's going to be vitally important is aid to state and local governments. They've seen their revenue sources dry up, income taxes, sales taxes as consumers go out and buy less. So we're likely to see enormous job cuts, spending cuts at the state and local levels. And so I think that aid to the federal government will allow aid from the federal government to state and local governments will allow them to keep many of those workers on their jobs, and that would allow for a stronger economic recovery. And then the third is what to do about those extended unemployment insurance benefits that are set to expire at the end of this month. For many households, that $600 a week is incredibly important in supporting their spending. I know that there have been concerns about the negative impact of the increased unemployment insurance benefits on labor force, and that some workers are earning more under unemployment than they did before the crisis hit at their jobs. We obviously want to make sure that potential workers have a strong incentive to go out and find a job. At the same time, unemployment is very high. Many of those workers their jobs have disappeared. They don't have jobs to go back to. Their entire industry may have been maybe structurally smaller, so there are fewer job opportunities for them. So we need to continue to support their spending in the second half of 2020, while at the same time making sure that they have a strong incentive to go out and find employment. I'm hopeful that Congress can reach some sort of compromise, but I think those areas will be key. We've seen about $2 trillion, a little bit more in stimulus spending. I think that I would not be surprised if we see another package of $1 trillion or $1.5 trillion. We can worry about the cost to the budget, the national debt later. It's much more important that we have a strong economic recovery. And it's also much more important that we have, as I mentioned, a very strong response to the pandemic. The longer the pandemic lasts, the greater the structural damage to the U.S. economy, and the longer the economic recovery will be, and the slower long-run economic growth will be. Our baseline outlook for the U.S. economy at this point is that we do see a good, solid recovery in the second half of 2020, but that it's going to be a long time for the economy to come back. I think by the time all is said and done, we're going to see about a 10% contraction in real gross domestic output of goods and services in the U.S. economy. Just to put that in context, during the Great Recession, we saw the economy contract about 4% over 6 quarters. We're talking about a 10% contraction over a period of a couple quarters, so a much steeper contraction in a much shorter period of time. We will see solid economic growth in the second half of this year as the rebound starts, and then through 2021 into 2022, assuming we get additional stimulus from the federal government. But it's going to take a good couple of years before we see the level of GDP return to where it was before the recession started in early 2020. So I don't expect to see economic activity return to its previous level until sometime in the sometime in the first half of 2022. The unemployment rate, as I mentioned, is 11.1% in June. I would expect it will be below 10% by the end of this year, somewhere around 7.5% or so by the end of 2021, and then below 6%, maybe close to 5% at the end of 2022. That's a good, solid recovery in the labor market, but remember, heading into this crisis, the unemployment rate was just 3.5% in January and February of 2020. So it's going to take a very, very long time for the unemployment rate to get even close to where we were in early 2020. I think that's just an indicative of what we've seen, the damage that we've seen in the US economy over the past 4 or 5 months. I do want to emphasize that the outlook remains very fluid at this time. So to be honest with you, I don't have a whole lot of confidence in my forecast. There are just so many unknowns out there about the path of the pandemic. Maybe we get a vaccine in the next 3-4 months that allows this to go away fairly quickly and we see a stronger economic rebound. Alternatively, maybe we have a bad flu season on top of the pandemic. Consumers continue to stay home well into 2021. That causes much weaker economic recovery and much more structural damage. Or even there's a potential for what economists are calling a W-shaped recovery, where we have a further contraction later this year because of the spread of the pandemic. Consumers start to pull back on their spending again, and certainly that we see the unemployment rate rise again in the second half of 2020. So that potential is out there as well. So just a huge amount of uncertainty out there. How effective these government programs are going to be, how effective we are in containing the virus, and so forth. I would encourage you to look at all of our materials at pnc.com/economic reports. We'll be putting out our July U.S. write-up later this week, and you can find that there. And then you can follow me on Twitter at Gus Faucher PNC. Thank you very much for your time. I see that we do have at least one question in. So the first question is can you comment on consumer confidence in flying commercial? And I would encourage you, if you have additional questions, to submit those now, and I'll try to get to those. You know, to be honest with you, there's a lot of psychology involved. It's not necessarily economics, it's psychology. You know, obviously some people feel comfortable in flying, but I think particularly as we see the pandemic continue to spread and get worse in many parts of the country, it's going to be very difficult for many people to feel comfortable flying. You know, you hear stories about the airlines and how well they're doing or not doing at maintaining social distancing on their flights and so forth. So I think the big question, the big unanswerable there is how quickly do we get the virus contained? As I mentioned, if we get a vaccine fairly quickly, the pandemic recedes, you know, later this year, then maybe people feel comfortable and air traffic levels return to, not to normal, but certainly bounce back very quickly by the beginning of 2021. On the other hand, if the pandemic continues to spread, as we learn more about it, you know, perhaps we have questions about how safe it is or not safe it is to travel commercially. So just a huge amount of unknowns out there that as an economist, I really don't feel that comfortable answering. Any other questions from the audience?
Looks like that's it, Gus. I want to take the time to say thank you very much.
You're very welcome, and thank you very much for having me, and I appreciate the opportunity to speak with you this morning.
Thank you. We'd also like to thank PNC for allowing your participation and their sponsorship and support of NAFA. It's been very generous. Thank you.
You're welcome.
Well, now we're going to switch into the panel portion of our session today. The next session is going to drill down into changes aircraft lenders are seeing with their portfolio and how those changes are being managed. So with that said, I'd like to invite our moderator, Rolly Vincent, to come online with the panelists that will be participating. Rolly Vincent is the president of Roland Vincent Associates. He's also the creator and director of JetNet IQ. He has a unique picture of our market from 30,000 feet. He spends time with data and analysis of our market and forecasting for our market. And so with what we've just heard from Gus, Rolly, it would be great to hear what you're seeing on the drill down to the private aviation world.
Thank you, Jim, and thanks, Gus, for those words of wisdom and lots of things to take away, and I've certainly taken a full page of notes. Really appreciate the opportunity to be with you. We have a great panel today. We'll just start with a couple of slides. I just want to share with you some data, just what we're seeing in the markets, and then we'll switch into the panel. We've got 4 experts in the industry, and we're going to have a little sequence of questions and answers. But let me just share with you just some of the state of the market views that we're seeing right now. I'm going to share my screen. Just bear with me a second as I get this up. And hopefully there you can see the screen. Can you, Jim? See that?
Yes, I can see it. Yep.
Okay,
looks good, Rolly.
Just share with you really a couple of things. These are from our JetNet IQ research reports. And just right into the data here. We've had, actually, it's an interesting year, fascinating year, of course. Thanks again, Gus, for those perspectives. What we're seeing here in the business aviation sector is really, we had a pretty good start to the year, actually. Our sentiment indicators from our JetNet IQ surveys were up about 9 points in Q1. So we started out really well, but look at some of these data points here on this screen. Deliveries obviously are going to be down this year. They've already indicated from some of the early data from Gamma. These are now from JetNet right through mid-July. We're looking at down 35–40% in terms of shipments from the factories. Part of that obviously due to furloughs and supply chain disruptions, as Gus mentioned. Look at retail transactions. That's a little bit more of the pulse of the market. There's very little delay between a purchase interest and a purchase decision. These things can happen quickly as opposed to the deliveries where there's often a backlog. There we're seeing, and we can see that data pretty quickly here, in the early parts of January, February, we're actually up year over year on the jet side in transactions. It then really slowed after the pandemic was announced in March, and we're seeing we're down 35 points from that point through end of June. So overall, down about 25 to 30 points in the markets. That's in terms of transactions. These are retail sales and leases that are going to an end user. Okay, a little bit more granularity here, some layers of the onion, if you like. Let's peel it back just slightly more. These data are from JetNet through the end of June. And here we're seeing inventory for sale. It's the number of aircraft that are out there on the market that are listed on these sites. And Jets, about 2,300 aircraft currently listed. The really interesting thing is if you go back, let's say 12 years to the last crisis that we faced, the global financial crisis, that we saw a tremendous spike in inventory. We're not seeing that at all here. People are hanging onto their airplanes. They're taking the good counsel of their advisors and just keeping the airplanes probably a little bit more idle than we've seen in the past, of course, but they're keeping ownership of those aircraft. They may be talking to their financiers, though, about rephasing some of their payments. Turboprops, again, no real bump in inventory. And then down below here, we're just going to look at some of the details, some of the more popular models that you'll see out there, the number of aircraft that are in the fleet and the percent for sale. But then if you look at the bottom line on this chart here, the very last line, these are the aircraft that are delivered in the last 5.5 years. And very, very limited inventory available. So again, if you're out looking for, if you're a shark looking for blood in the water, really not seeing a lot in this industry. There's a limit to what's out there. So, okay, I'm gonna stop sharing my screen, and now we're gonna switch gears here a little bit. And I'm gonna introduce, we have 4 expert panelists. These gentlemen are informed, they're engaged, they're experienced, and they're leaders in the sector, and that's why they're here with us today. I'll just quickly introduce everyone. Mike Smith. Mike is the VP and lender for Scope Aircraft Finance. Welcome, Mike. Robert Labano is with Wells Fargo. He's SVP and National Sales Manager for Wells Fargo Equipment Finance, focusing on corporate aircraft. Welcome, Robert. Gary Critchlow, welcome from London, UK this morning and this afternoon. And in the UK, of course, Gary is Director of Aviation Finance for ARC & Co. Welcome, Gary. And JC Fair, no introduction needed. He's partner with Holland & Knight, a leader in the industry. So welcome, gentlemen, glad to have you. We have a few questions that have been, we've organized for all of our listeners, and we're gonna start with those. We'll walk through these questions, and we're gonna open it up, of course, at all times for your comments and questions. Please use the chat function for that. First question, how have lending strategies changed due to the pandemic? And I'll just open that up. Perhaps we can start with Robert from Wells Fargo.
Yeah, thanks, Rolly. And first I want to thank Jim for inviting me to participate in the webinar. I appreciate the opportunity. This is an important topic that we're all navigating through. You know, I think you look at the number of participants on the call today, and I think everyone's very interested in how everyone is managing during this unique time. So really to answer your question, from our perspective, we really haven't changed our lending practices. We're still really focused on 3 main areas. One is, you know, really kind of focused on our clients' credit strengths and what their financial needs are for supporting aircraft financing. Also, we're asking more questions around the pandemic. How are they handling the pandemic? How has it affected their business? And, you know, what is their outlook for the remainder of this year, and what is their outlook for next year? These are conversations that we never had to have before, and they're important conversations today, and they're really just part of now the underwriting and inquiry process around having these conversations with our clients. And then thirdly, you know, our mission, and I think most everybody understands, is that, you know, we're here to service our existing clients. That has not changed. We understand our clients very well, what their needs are. and it's been very successful for us. And so we continue to want to just monitor and service our existing clients. Now, we are a domestic player. Wells Fargo is an international company, but for the corporate aircraft segment, we only focus on our U.S. clients. And that's been successful for us. And we'll talk a little bit about our portfolios in a minute. But I can't give you an international feel. That's what Gary's here for. So I'm going to have Gary kind of respond from his perspective. He's in the UK and he has more of the international take.
Sure. Thanks a lot, Robert. Yeah, I mean, basically, I think the name of the game that's been outside the US has been one of pragmatism. All the lenders that I deal with on a regular basis, the overall objective has been everyone wants to avoid a flood of aircraft coming onto the market. And, you know, to your point, Rolly, we haven't really seen that, which is good. So, I mean, just looking back over how this has played out in the short term, you know, many lenders would started with the approach of protecting the portfolio. So focusing on existing customers' needs. You know, there are some lenders who are pulling human resources from the origination team onto the portfolio management team, just everyone hunkering down, waiting for a flood of deferrals. And that doesn't seem to have happened, at least not with the lenders that I've spoken with. You know, also, you know, there's been a lot of government-backed support schemes in different countries around the world, and lots of aircraft lenders have actually been participating in them. These schemes, you know, they enable asset-backed lending, mostly on the smaller end of the jet and turboprop market, and, you know, to be extended to domestic businesses. So, for example, here in the UK, the Coronavirus Business Interruption Loan Scheme has been, you know, quite active with some of the lenders here. There are parallel schemes, I know, in Canada, Germany, Australia, other places where the aviation financing community is large and active. But, you know, I mean, in terms of how lenders are looking at it, they tend to, I think, mirror what Robert was saying. You know, basically, the same type of questions are being asked around the credit strength, the ability to service the loan. What's the impact of COVID on the obligor's ability to service the loans? Some funders I speak with regularly, they've actually determined that certain sectors of the economy or certain geographic areas are too fragile or uncertain to lend into. So things like hospitality, oil and gas, retail are some areas that have come under a lot of strain and our areas of focus. Other funders, they've become more conservative in terms of their LTVs or the guarantee requirements they put in place. They'll price a higher element of risk in terms of their margins, or even restricting the age of the aircraft that they're looking at, you know, to try and tighten the risk profile, basically. On the other hand, the other thing I'm seeing is that as some lenders have retrenched from certain markets, and I'm thinking in particular a few in Europe, for example, others have actually kind of expanded into the space. And that's not just a European thing, but I'm also seeing it in emerging markets in Asia, sub-Saharan Africa as well. I mean, I guess it all comes down to individual circumstances of each transaction, but certainly from an international perspective outside the US, aviation finance is very, very much alive and kicking around the world.
And to add on from an owner loan perspective, I mean, the biggest challenge I think we're facing right now is the concept of trying to use pre-COVID financials to underwrite in a COVID environment, right? Everything we look at was pre-COVID experience. So we have to look at how to make a lending decision in that environment. And in that case, what you do is you look back to the old-fashioned 5 C's of credit, you know, study each component of the lending decision, see what the COVID impacts are for that, and then work to make sure you have a situation that benefits both the customer and the bank from there in the lending decision. I do admit, though, the credit that comes in with high liquidity and low leverage is definitely preferred.
That's great. Thanks, Robert, Mike, and Gary. Just quickly, we have a question in from the chat room, and it says, let's see, what impact do you feel the pandemic will have on older, aging aircraft? Maybe I'll take a shot at answering that. We actually have a poll out there with the owner-operator community. We asked them, have they parked an airplane, for example, or typically that'll be either somewhat an older airplane. 18% are saying, yeah, they very much agree that they've parked an airplane, and about 12% somewhat agree with that statement. So in our forecasting models, we're also seeing an increase in the retirement of older aircraft, pretty much for sure, I'd say. That's almost certainty. Okay, let's switch to the second question. And the question is, how are you managing the first and second wave of deferrals? And that's an interesting question. Start with Mike on that one. Mike?
Yeah, absolutely. So we tried to remain disciplined in our lending practices even pre this environment, and using those disciplined practices when the first wave came in, we were pretty confident in our positioning, both from a collateral and credit perspective. So we were able to accommodate those requests as they came in, be it interest-only payments or deferrals or what have you from there. Second wave, so far, there hasn't admittedly been any wave yet, but wouldn't be surprised if we see something coming on the horizon. And in that case, I think we will look at this one differently. We'll make sure to try to look at each situation for what it is, talk to each customer, and understand the situation from there to work out the situation that best benefits both parties. Robert, what's happened in your neck of the woods?
Yeah, so it's a similar story. We've been fortunate that we have not had many requests for deferrals on our aircraft segment of the portfolio. And those that have come in, they've really been an accommodation for our clients. So there's been there's been some, but little, risk review for that process. We just went ahead and processed them. Now, if there is a second wave and we have not experienced a second wave of new first deferral request, or B, those that we have already requested deferral want a second deferral, we haven't experienced that either. But if there is another wave of those that want a second deferral and they already have one, we'll take a look at the risk, the credit on those, and spend a little more time to really understand why they're asking for another deferment on top of what they've already been provided. So it's kind of a good news story for us. Now, this all can change as the pandemic continues to unfold. As we've seen, certain states have been opening, and now there's discussion around certain states or counties and cities going back to some more of the stay-at-home type of orders. So that may make a change, but so far we've had a good news story from that perspective for us.
Yeah, that sounds pretty much same with my experience so far outside the US. Is pragmatism is still sort of reigning supreme. Certainly, I haven't had any notes of people sort of managing lots of all hands on deck in terms of managing defaults and things like that. We have had some lenders have had quite a few deferral requests, restructurings, and they're basically working through those issues. But I think again, everyone has been relatively disciplined up until this point, and that's enabling them to, kind of take a bit of slack in the system. And so yeah, that's really helping.
Yeah, we think of GBP as, obviously the pound sterling, an acronym for pound sterling, but it also means the great big pause. And I think a lot of people are really just, the deferral activity is kind of low. Let's talk about defaults though right now. I mean, that's the other question. Deferrals are now defaults. And do you think there's been an increase in the default activity due to the pandemic? And do you anticipate an increase? And if so, how are you planning for that? Let's start with JC.
Yeah, so luckily we have not been seeing a large amount of default activity, actually very little default activity, and certainly very few, if any, foreclosures like the other panelists have mentioned. There's definitely been a good amount of patience on the banking side, which is obviously good because you don't want to flood the market with foreclosed aircraft. I think there's a lot of reasons for this. Probably the main one is the patience on the banker side, but frankly, I think that borrowers, in comparison to other recessions, were in a better position. The economy was humming when this pandemic hit. So I think people were in a better cash position at the beginning of this. Now, having said that, and again, as has been mentioned, we've definitely seen more deferral requests, and the banks have been generally accommodating to those. Going forward, to the extent that the economy continues to putter because we can't get a solution to this pandemic, I think it'll be really interesting, and I suspect that defaults and foreclosures will definitely increase going forward, especially now given that all the government support is basically being exhausted and people are burning through their cash. I suspect that there could be an increase in the future unless we can get our hands around this pandemic in fairly short order. Robert, what are you seeing from your perspective?
Yeah, so it sounds very similar. So from our perspective, the good news is we haven't seen any default activity around specific pandemic issues. And quite frankly, our portfolio is performing very well, generally speaking. Again, I think that's just a testament to us really focusing in on our existing clients and having broader relationships with our clients. So right now, there is no indication. We are tracking the portfolio. There are important metrics that we view, including slow pays on 10 days past due and all that. But everything right now seems to be pointing in the direction that there's been no indication that we'll have defaults at this point. And so we're cautiously optimistic. Hopefully that trend will continue. Again, I think that as the pandemic unfolds and things change, or for the worse potentially, or then that may be a little bit of a different story. What about you, Mike?
Yeah, we're kind of in the same boat again. We've been incredibly lucky to have very limited default activity so far, but as we've all suggested and everyone feels in their own lives, it's still pretty early in this whole process. So I think there's a lot of opportunities to learn going forward from there. One thing that I have picked up so far is that an industry associate mentioned to me a couple months ago that in tough times, it's the relationships that matter. Good relationships with borrowers help make the workout or sale or adjustment situations much easier to work through. So I personally and the entire Scope team have been using this time to try to build those relationships with customers, even though there may not be economic distress happening with them directly. Now is a great time to get to know everybody better, to make it easier once it does happen from there. So Gary, what's going on across the pond?
Yeah, I mean, certainly because I'm not a direct lender, I can't speak definitively, but certainly in terms of the conversations I've had with the various lenders that I deal with on a regular basis, again, default, the portfolios have been holding up, and certainly just looking at the poll results, it would seem that the people on the call are sort of reflecting that stance as well. That fortunately, nothing has the wheels haven't come off the bus yet, but I think everyone is looking towards the longer term in terms of as the economic fallout hits the real economy and what that does for people's spending habits, people's access to liquidity. As you said earlier, it's still early in the process.
Okay, let's switch to the next question. It has to do with the portfolio performance. And let's think of this cycle versus, let's say, 2001 or 2008, the last two recessions that we've been working through. We'll start with Gary. How has this cycle been different from a portfolio performance perspective?
I remember sort of working through as an analyst in 2006, 2008. And I think there's some real key differences, particularly between this one and the most recent one. I still remember, and I'm sure everyone on the call will remember, the big three automakers flying to Congress in 2008, asking for a bailout. And I remember thinking that was the death knell of aviation, of business aviation, and it certainly was a public perception nightmare. And I think one of the key differences this time around is that whole public perception of business aviation is that rather than being seen as an expensive luxury, it's actually seen now as a health bubble, a health corridor, some way to get your employees safely to places that they need to go without having to go through 700 touch points at a commercial airport. And sometimes it's the only viable means of getting somewhere as commercial aviation has pulled back. It's been absolutely decimated. That's one key difference. I think the second key difference, it echoes what Gus was talking about earlier, is that this is an externality to, it's not caused by the economy. The fact that liquidity is still available, so cash is still there for businesses to support and finance their operations, whether directly from private markets or with some of the government support schemes that are now in place for this. So liquidity is still there. And then I think the third piece is, again, what some of the panelists have talked to already, is that financing up to this point has been still disciplined. So there still is flex in the system to restructure, to deal with problems. And allied to that is the fact that aircraft values as well haven't mushroomed in the past 10 years as they did in, say, 2006, 2008. So what that basically means is that we haven't had a flood of people being driven to exit the market, either because they can't afford their aircraft or because, you know, their shareholders are forcing them to divest themselves because of the public perception. You know, and certainly in terms of the financiers' sophistication in managing things, I think they've certainly upped their game, but you know, it still remains to be seen what will happen as the economic recessions take hold. So that's basically my perspective. JC, how about you?
Yeah, I mean, I certainly agree with that. I think it's just this recession is fundamentally different from the last two, the ones that we experienced in 2001 and 2008. There were macroeconomic issues that drove those recessions. In 2001, it was the dot-com bubble. It was exacerbated by the 9/11 attacks. In 2008, you had the housing and financial markets that were a mess. In this case, this was a black swan. It just, a humming economy got punched in the face and stopped cold. So it's different, but by the same token, that difference has helped, at least in the short term, borrowers stay afloat, because again, the economy was doing well, companies were flush with cash, and that has allowed them to stay afloat, at least again in the short term. The big question is the recovery, and as Gus mentioned, how is this going to work? Is it going to be a V-shaped rapid recovery? I don't hear a lot of people talking about that. A lot of people seem to be talking about a long-term recovery, which again could affect portfolios and how people can service their loans. And that's all tied to the vaccine and when we can get control of it and get consumer sentiment back in line so the economy can get going.
Okay, let's go to another question here on feedback from clients. And we heard a little bit about KYC, Know Your Customer. What kind of feedback are you hearing from clients regarding managing their current aircraft and or thinking about another airplane, a replacement airplane? Maybe we'll start with Mike.
Yeah, absolutely. Overall, so far, I think this environment has definitely changed the value proposition of owning an aircraft, especially in the owner-flown markets. So we've seen a desire to hold on to their aircraft, a desire to possibly upgrade their aircraft. I have an example of a customer who we financed a Phenom 100 for 24 months ago with a 5-year plan to trade up to a Phenom 300. And he and I spoke 2 weeks ago with a desire to upgrade sooner if the values are there to purchase an aircraft right now. I felt comfortable in a financial position for that. So in fact, it seems to me in our short example so far that the owner-flown owners are doubling down in their opportunities to own aircraft. Then you add in this low rate environment and a desire to hold on to cash. We are definitely seeing an uptick in financing of those acquisitions as well. Robert, what are you seeing?
Yeah, thanks, Mike. Kind of the same story. I would kind of, put our activity and new customer kind of discussions around 3 buckets. One would be, the first-time buyer maybe accelerating when they get into an aircraft because of the pandemic and the challenges with commercial travel, and so now they're interested and they're looking. The second would be what you had mentioned, Mike, is the current rate environment. It's an attractive time with low rates to purchase an aircraft, finance an aircraft, refinance an aircraft. So I think those are some of the discussion points we're having. And then thirdly, I think there's a little bit of pent-up demand where clients have put purchases on hold, and now they can't hold anymore, or they don't want to hold anymore, and they want to get into that aircraft. So I would kind of frame around those 3 buckets of topic conversations. And again, I have to preface it again by saying, look, next month could be a whole different ball game depending how things unfold, right? And so we're kind of flying here on a week by week basis based on the news and based on the pandemic and what's going on. But those are the conversations we're having with our clients.
Okay, next question. How do you manage risks of onboarding? So bring new customers on board in this current environment? And that's an interesting question. I think we'll start with Robert on that one.
Sorry, one of the questions popped up on my screen here. I had to get rid of that. So we're pretty efficient. And look, we're a large bank. We're very efficient in terms of onboarding customers. We're very electronic. focused. We don't do in-person closing calls. It's all by phone, conference calls. So we're, and clients are actually demanding, and our clients are certainly demanding more efficiency around closing, and their time is valuable. So I think that's pretty common in a lot of the sectors of this space. And the other part of that is, the third party providers and working closely with them and making sure we've got the right vendors on board so we can close in an efficient way for our client with a trustworthy third party client, or vendors.
Yeah, we kind of have two big points in the owner phone space. One, in terms of the transaction itself, the logistics of going to see the aircraft. Not our part specifically, but in terms of the vendors in the transaction, like Robert said, the logistics of going to the aircraft to do the pre-buy, depending on the airline and quarantines and whatnot across the country, those have impacted the transaction process. Then on our side, nothing's really changed from doing everything electronically. We were already moving in that direction anyway. What has changed is while everyone is working from home, we have an infrastructure that now is also reliant on people's home Wi-Fi. And I know how much my Netflix buffers when I'm trying to watch it. So trying to do a closing can get a little more complex in that regard too.
Yeah, I'd probably add to that in terms of just the logistics of the physical on-site things. Certainly internationally, it becomes even more of an issue, with certain countries basically having to quarantine anyone going in for a certain period of time. It just becomes very difficult to manage those challenges. And I think that's probably the key bottleneck that I'm hearing from, when I'm trying to get deals closed, is basically along those lines of getting the engineer to, whether it's, to fly from Bournemouth in London, Bournemouth in the UK across to the continent to look at an aircraft, or vice versa. It becomes a real challenge. In terms of the other parts of the puzzle, in terms of legal counsel, again, because there are different jurisdictions that we have to deal with. So that's also an issue, less so because, again, whether you're practicing English law, New York law, or Swiss law, you can still work from home. But those sorts of logistics of the transactions are certainly areas that are, make things a little bit slower. But the key bottleneck right now is really the on-site inspections.
I think that's a really key point. A lot of us are focused on things like the civil airliner industry, looking at 90% reduced travel, and that looks so awful compared to our industry's performance. But at the same time, all of us on this call, I'm sure, use commercial airlines to do our business on business aviation side. Interesting point. Okay, the last of the pre-prepared question before we open it up. The question is, has there been a shift in your origination strategy due to either the pandemic or your portfolio's performance? And we'll open that up. Maybe we'll start with Gary.
Yeah, well, one of the interesting things that I've found is that, especially because I'm not a direct lender, so I sit as a broker to connect people with various forms of finance. So often one of the challenges that I get is, well, what value do I add? And certainly in an environment like this where, the whole process is just more complicated, all of a sudden I'm finding that people are beginning to see that value much more easily, especially as certain lenders in certain jurisdictions may, change their lending requirements or become less responsive because they're focusing on other things. What I've found is that basically selling the value of having someone who knows what they're doing and is in constant contact with various lenders to understand and how their appetites are changing. I'm finding that sort of advisory piece is really kind of coming to the fore now. I think the other area for me is that people are much more receptive to the idea, the benefit of finance, basically the fundamental benefit of finance being, instead of locking your cash into a depreciating asset, you're able to use that to do more stuff with it to generate a return. And certainly in an era like this where cash is king, everyone needs that cash to keep their businesses afloat while this pandemic goes on. That story I've found has been resonating a lot more over the last few months. So that's basically kind of what. So I've found that, in a sense, selling the story of aviation finance has become easier.
And we haven't seen much of a shift in our strategies at all at Scope or for the owner flown space. The biggest thing that a coworker told me the other day as we were talking through this kind of stuff, we do our work and maintain discipline in the good times, so we're prepared for these moments. So I think the biggest piece of advice I'm trying to follow is learn the lessons of right now and keep these things in mind when things do get frothy again one day. So we're all best prepared to handle the next thing, because there will be another thing that comes up, whatever it is. Just be prepared for that moment now.
Yeah, and I would agree. I mean, from my perspective, we haven't changed our origination strategies, and this is really one that came out of the last downturn, and so we're fairly confident and we're doing the right thing in terms of what's right for us, servicing our existing clients, and really trying to meet their financial needs for their aviation. So no significant changes on our side.
Okay, I think that'll sum it up. Wait a minute, we have a question here come in. In this low interest environment, is your organization trying to increase yield by either using floors or increasing your spreads or margins? You would never do that, Joan. That's a question.
I think one of the things that I can, maybe I can speak at least for some of the lenders I've spoken with. Yes, there is a temptation there, but by and large, I think, you know, the funders that I've spoken with are, you know, they're cognizant of the fact that, you know, this is a difficult environment. So they don't want to kill the goose that lays the golden egg. At the same time, I think it's fair to say that this is a higher risk environment, and certainly where funders can price in that higher risk, they will.
Just generally, I'd like to share a little bit what we're hearing and seeing. I think we've just heard from some amazing experts around the industry, different perspectives on what's been going on. I think all of us have to be aware, and we are aware, that how we're behaving, how we're acting, how we're thinking right now, people are going to remember this, and, you know, how we handled things during the more difficult period. I think that's going to really be important. So I first of all, thank you for being with us, of course. One good news that we're seeing as we do our pulses and our surveys around the industry, more than half of owners and operators are looking at another airplane, are expecting to finance that aircraft. I mean, we've been tracking this for a while. That's not changing. Financing is a very, very big deal. And, you know, currently I think we have some very attractive conditions, obviously with the risk, as we mentioned. I'm going to hand it over. I'm looking at other questions. No, I'm not seeing them. Jim, do you want to take it from here?
Yes, thank you, Rolly. Very much appreciated for your time, and for the panelists, JC, Mike, Robert, Gary. Appreciate you all taking the time. Gary, appreciate your staying late with us today over in the UK. A few closing comments. I think that we've been encouraged by what we've heard on the prospects for the economy. It also was really encouraged to see, Rolly, your statistics on how much the activity might be below where the remaining market is. When Gus took us through some of the economic components of the market and how we're down with auto sales, for example, compared to aircraft sales and aircraft production, that's pretty encouraging. It does seem like there's a higher concentration of people that are financing today, and it seems like our lending group is well poised, as JC said, not experiencing the same impacts that they experienced in the last two cycles. So I'd like to let everybody know that we've got our next webinar coming up on August 25th, Preventing Fraud in Aircraft Sales and Lending. And it'll be at 11:30 again, and we welcome everybody to participate in that. At the end of this session, when you exit your Zoom meeting, you'll see a questionnaire. We very much welcome you to take part in answering those questions and giving us some guidance as we frame our next few webinars. But other than that, again, want to thank everybody for participating. It's been a great panel today, and have a great day.